Well, welcome back to part two. I guess I didn't scare you off too bad if you came back, or else you have to. I'm not sure which. But we're going to do the overhead variances on this one. So what we have here is the layout I have for overhead variances that you need to become aware of. The first one is just the one variance method, which is the overhead variance. And then what we'll do is we'll separate that between the volume variance and the budget variance. And then what we'll have for the three variance method, we'll take the budget variance and separate it between the efficiency variance and the spending variance. And then for the four variance method, we'll take that and separate it between the fixed and variable spending. So your total variable overhead variances is the variable spending plus the efficiency. The fixed variances is the fixed spending plus the volume variance. Those are your fixed overhead variances. And the reason why I do this is because these two added together gives you the spending variance. The efficiency and the spending variance will give you the budget variance, and the volume plus the budget variance gives you the overhead variance. Okay, so with that, we'll go into the variances. And here's what my overhead. The first column is the applied overhead. That's just the normal application rates. Then we have the flexible budget based on the standard activity, and the difference between these two is the volume variance. And then the third column is the flexible budget based on actual activity, and the difference between those two is the efficiency variance. And then this column is the actual overhead, and the difference between these two is the spending variance. And then the variable spending is simply you subtract the lines individually. Okay, we're going to do this. We're going to do an example for this, so don't panic yet. Okay, for the example, we'll have back up here to our normal example we have. This was based earlier. We have the 330 as the 0.75 times 440, and 0.75 times 560 is 420. Okay, while we're up here, so what we'll do with that, okay, that's the numbers we want to use for our examples here. And the fact that we produce, this is based on 12,000 trophies for our fixed overhead rate, which we'll get into a little bit later. And it's 440 and 560 respectively. So we'll come down here. We've already done that. And I already typed these in here. So that's the variable and that's the fixed. So what we have here, our actual production was 11,200 units. It takes 0.75 hours. So our standard activity should be 11,200 times the 0.75 or 8,400. Okay. Now the application then, remember we take the standard hours that we did times, in this case the 440, and that will give us 36,960. And for the applied fixed overhead, 8,400 times the 560, and that will give us 47,400 for a total of, all we want is those two numbers, $84,000. Okay. Now remember the standard hours was 8,400. That's why I have 8,400 up here. So for the variable, we'll take the 8,400 times the 440. And you notice that's the same number we have over here, which it should be, because remember the characteristics of a variable cost is the cost per unit stays constant, but the total is what changes. Well, since this is based on 8,400, this one's 8,400, that should be the same as this one. So that's no problem. Now, the fixed, however, is a different matter, because remember the total is what stays constant. The cost per unit is inversely related to production. So over here, we actually produced, well, our standard was 12,000 units at 0.75 hours. So that's equal to 12,000 times 0.75. Our standard hours for normal capacity was based on 9,000. Our rate was 560 per hour, which means our overhead then would be these two multiplied together, because originally we took 50,400 divided by 9,000 to get to 560. This is reverse of that, so this will be 50,400. And then this is those two added together, which is 87,360. Okay, so this is equal to the ABS 84,000 minus 87,360 and that's larger, so it's unfavorable by 3360. So you take 84,000 minus 87,360. Remember, you don't have positive or negatives. So that's 3360, unfavorable. Okay. Now this one is fixed, so that's going to be 50,400. That's my fixed overhead. But this is based on 8,500 units because that was my actual hours I worked. So we have equal, in this case, 8,500 times the 440, which is 37,400. So this is those two added together, which is 87,800. So now we take equal the ABS, 87,360, 87,360 minus 87,800, or 440 unfavorable. Okay, this is what's given. This was 36,800 because that was given up above, and this was 50,000. So that's those two added together, which is equal to the ABS, 87,800 minus 86,800, or $1,000 favorable. Okay, this one is activity is those. Now this cell here minus the 36,800, and that's favorable because that one's smaller, and this is the same thing. So I'll just copy that down. It's 400, and these are those two added together. And remember this cell. Remember these two numbers here have to equal this number here. Okay. Now for the two variance method, I already have it down. The 3360 just comes down. This one is the 1,000 plus the 440, or minus in this case, because this is favorable, this is unfavorable. That gives you the 560. And then this one is the 3360 unfavorable minus the 560 to get 2,800 unfavorable. That's the one variance. So that's how you get the two. These two added together gives you this one. Remember, it's favorable and unfavorable, so they're subtracted. And then these two added together gives you this one for the same reason. Okay. Now for the journal entries. This is to record the actual overhead. So that's these numbers right here. Okay, so that will be the 36,800 and the 50,000. And that adds up to 86,800. Okay, now what I've done down here is I put in the T accounts, my T accounts. So that's 50,000, and this one is 36,800. Okay, that gives me a little total down here, and you'll see why I do that later. Okay. Then we have the work in process, and that comes in as standard, remember? So the work in process is will be equal to the 84,000. Okay, and then the credits to the variable, well, this was the variable, and this was the fixed. Okay, so we come down here. For the fixed overhead, we put in 47,040. I think that's what it was. Yep, 47,040. And for the fixed, I put in 36,960. Okay, I have these already over here so that it calculates it for it. Okay, this is my balance column. Debit, credit, balance. Okay, I use a double T account. Okay, that's for the work in process. For the volume variance then, this one is the 3360 unfavorable. So that's 3360. And then I have the factory overhead fixed is 2960, and this is 400. Okay, this is the fixed overhead variances, and this is my fixed overhead accounts for 2960. So I put a credit in here for 2960. Notice that zeroes that account out. because that's what I'm doing the variances. For the variable variances, I have the efficiency variance, which was a debit for 440, and I have the variable spending, which was a credit for 600, and the difference then would be 160, and that's a debit to the factory overhead variable variance. So over here I put in 160, and you notice that zeroes that account out, so everybody is happy. And now that's the entries to record the factory overhead and the variances. Okay, you record the actual overhead first, the applied overhead, and then you record the variances, and the adjusting balance in is like this one is for the fixed overhead, and this one's for the variable overhead. And that can go either way depending on which way you need it. This is for the closing entries. So for the closing entries, the fixed overhead spending was a debit to 400 because it was a credit up above. This one is a debit for 600 because it's a credit right there. I can tell you the cost of goods sold is going to be 2,800, and we know that because that one also will equal the one variance method. That will close it unfavorable, so it's to be a debit to the cost of goods sold. And this one is for credit for 3,360 and 440. Okay. All we're doing here, the debits for the variances are closed out because the factory overhead account's already been closed, and then the variances will be closed into the cost of goods sold. Okay. I'm not sure how much you're going to be doing variance with journal entries, but I just thought I'd go through those. Okay, the hard part here is this 50,400. Remember, on the 50,400, we have to go back to what our normal capacity was going to be, 12,000. Standard is 0.75 to get our standard hours of 9,000 hours. Our standard rate is 560, so we multiply it, and that gives us our 50,400. Because originally we said our estimated overhead was 50,400, standard hours was 9,000, and that gives us a rate of 560. So you kind of work backwards on this one. So that is the overhead. Okay, and that's based on this example up here. And if you want to go through it again, there it is. And I'll be more than happy to review this, go over and over it again, because overhead is the one that really causes the problems. Okay, remember, this is applied overhead. This is your budget based on standard activities. This is your budget based on actual activity, and this is your actual overhead. And then you take the difference of each of those columns, and that gives you the differences for those three, and the difference between these. Did it again, didn't I? The difference between those two columns gives you these two answers here. Okay, so that's overhead variances. Hope this helps, and we'll see what happens next time.